Coming up on Business Incorporated. Nigeria set to lose frontier market status as dollar shortage bites. Kenyans cut back on mobile calls as excise duty charges increase. Plus, Egypt holds key interest rate to weigh effects of recent hikes. Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at how your money is performing at intraday. Starting off with African markets now, where sentiments were mostly positive. At intraday, Nigeria's NGX continues its recovery. It's up 0.08%, while South Africa's index took a much bigger rise, up 0.88%. Egypt's equities market closed Thursday, but did finish trading in negative territory. Same with Kenya, which also closed down about 1.72%. Both still remain worst performing equities in Africa. And now to the Middle East. Major equities were also negative. At intraday in the United Arab Emirates, Abu Dhabi index was down 0.18%, while the Dubai index was also in negative territory. Still within the region, Saudi Arabia and the Qatari exchanges, which had closed on Friday, closed the trading sessions negative yesterday, lost about 0.08 and 1.59%. respectively. We're still seeing that downtrend in those markets we track in the Middle East. All right, now let's take a look at what's happening in Europe. We see the German government warns that certain industries would have to be shut down if there's not enough Russian gas come winter, amid the attempts to compensate dwindling energy deliveries from Russia. Discussion whether to extend the operational lifetime of Germany's nuclear power plant is gaining momentum. Let's hear more now from Chris Kober right there. Great to have you, Chris. So who's been advocating this idea?
There have been a number of political leaders, most notably Germany's finance minister Christian Lindner of the Liberals, who didn't openly call for an extended use of nuclear energy, but said the matter should definitely be looked into. Leaders from the biggest opposition party, the Conservatives, have for quite some time been much more vocal in their support for nuclear power. Among them, the state leader of Bavaria, which is home to one of the 3 remaining nuclear power plants here in Germany. Back in March, Markus Söder demanded a multi-year extension of lifetimes of these reactors. Other party members have been pointing towards the fact that in all of Germany's neighboring countries, nuclear power plants are operational, so this could also be done here. Business groups, particularly from high energy consuming sectors like manufacturing, have also been gathering behind this notion, and a recent poll among German citizens showed that amid all the problems Germany is currently facing with regards to energy supplies, 61% of those asked said they supported an extension of lifetimes for nuclear power plants in the country.
All right, but what's the problem with keeping these reactors on the grid?
There are several issues. First of all, Germany has put its exit from nuclear energy into law, and that dates back to around 20 years from today. Of course, this law can and has been amended, but following the nuclear disaster in Japan's Fukushima 11 years ago, then Chancellor Angela Merkel decided that Germany would wind down and ultimately quit relying on nuclear energy, and the current government have also signed up to this plan and put it into their coalition agreement, which would see nuclear phased out by the end of this year, and which paid energy companies, mind you, 2.4 billion euros, or more than $2.5 billion to do so. Also, fuel elements and the necessary maintenance intervals of the plants had been precisely coordinated according to this long-decided nuclear phase-out. The Chancellor, Olaf Scholz of the Social Democrats, said this week to get new ones, new fuel elements, would take at least 12 to 18 months, he stressed. And energy companies are opposing this idea because to them it seems like taking a step backwards. In a grueling and often costly process, they have long changed their business trajectory towards renewables and are glad to have left this whole process behind, executives say. Perhaps most importantly, though, the government, or at least large parts of it, don't seem interested in extending the operational lifetime of nuclear power plants. Prolonging the use of reactors would be not an option, a statement from the Energy Ministry said this week. That's why currently I don't think there's a big chance of an extension of nuclear in Germany, but this war, the war in Ukraine, has changed many long-standing positions in German politics practically overnight. And the Kremlin's pressure is likely to grow further, which could have the energy crisis that Germany finds itself in currently take a turn for the worst. A point at which the frictions that we see right now between Social Democrats and Greens opposing an extension of nuclear, and the Liberals, which say it should at least be considered, these frictions within the German government could become more troubling.
Right, more troubling there. But let's take a look at financial markets now. European stocks mostly posted losses yesterday. What does today's session look like?
It looks like a conciliatory end to a week that has seen more heavy losses on financial markets. Utilities and healthcare stocks helped lift European equities from 2022 lows. Today, the DAX in Frankfurt advancing around 0.3%. The slight gain supported by falling bond yields. Germany's 10-year yield, the benchmark safe asset for the euro area, has fallen almost 30 basis points this week. That's the first weekly fall since mid-May and the largest since the first week of March, underpinning the concerns investors have about faltering growth and a potential recession.
All right, Chris. Well, we'll see how markets close today. Thanks so much. That's Chris right there in Berlin. Let's move on now to the UK. We have Juliana standing by right there. Great to have you, Juliana. So Boris Johnson is in Africa right now, but what are the reactions to that devastating by-election defeat?
Yeah, I think devastating is a good word, Laddie. The Conservative Party have lost 2 parliamentary seats, and swiftly after that, they also lost their party chairman because Oliver Dowden, who up until about 48 hours ago was a staunch ally of the Prime Minister, he handed in his resignation, saying that we cannot carry on as business as usual. I think it's important to kind of look at where these locations were. One was in Wakefield, which is a northern English industrial town. It was famously taken by the Conservative Party during the 2019 general election, where we know that the Conservative Party broke down that red wall. But in Tiverton and Honiton, that is in the southeast of England. This is in the Conservative heartland, a place where the Conservative Party had over a 24,000 majority. They lost that seat to the Lib Dems, and in Wakefield, they lost it to the Labour Party. So it clearly shows that the broad appeal of Boris Johnson is getting frustrated. He is, as you quite rightly said, taking part in Chogum in Rwanda this week, and he has been speaking about the defeat, saying that he is going to start listening to voters, that he is going to do more for the cost of living crisis. He will be trying to cut taxes where possible. But I think for some people it's just not enough. First of all, it's pretty embarrassing because typically when we have gatherings such as this on the world stage, it's usually the African leaders that have something to hide and looking from front to left, waiting for the scandal to appear. This hasn't happened this time. This is the African leaders looking at Britain, that's supposed to be the beacon of democracy, going through a pretty tough domestic political time at the moment. And then, of course, also the fact that we've had a pretty senior resignation from a Johnson ally does mean that there's potentially more to come. Now, Boris Johnson, of course, as we know, has refused to resign. He says that by-elections are never easy, so he didn't expect to do well. But you definitely get a sense from the Conservative Party, from prominent backbenchers, that enough is enough. They may be pushing through a further vote of confidence. I know the current laws state that it cannot take place twice within a year, although I think they are trying to change the law. And then there is also a parliamentary scrutiny committee that will be looking into the conduct of Boris Johnson and deciding themselves whether or not he did indeed mislead Parliament. So it's certainly not over, these political woes for the Prime Minister. But again, a really crushing defeat, a triple blow, and the fact that he is supposed to be on the world stage showing how great and awesome and mighty the once Great Britain was. But clearly, under his tenure, it hasn't been that way.
Yeah, so much pressure on him right now. But let's look at some fashion now. See, a modern vintage brand as Kidston has been put up for sale just 2 years after collapsing into administration with the loss of nearly 1,000 jobs. Who are the buyers lining up for this?
Yeah, we don't have much information about this. Sky News are reporting it, and they say that PricewaterhouseCoopers are they are overseeing this sale. I believe they've been speaking to prospective buyers for the past couple of weeks. But Cath Kidston was once a pretty popular high street staple in the United Kingdom, very much known for the kind of polka dots, flowery, kind of vintage, modern vintage look. But as we have been discussing over the past couple of years, it's just been a really torrid time for retailers in the UK, particularly those bricks and mortars shops that rely on customers coming in. It's really difficult to try and compete with fast fashion brands such as Boohoo and ASOS as well. And Cath Kidston was one that really struggled. They went into administration a couple of years ago, putting about 1,000 jobs on the line. They were taken over by a Pan-Asian firm, but I believe that firm has now called in PwC to oversee this sale because they're just not selling and as popular as they once were. I believe they stopped going into stores, and they're now mainly just a wholesale brand. But even as a wholesale brand, figures aren't as bright as other brands. So yes, we're definitely going to be saying a long farewell to what was once a much-loved British retailer.
Long farewell. Well, it's the last trading day for the week. How are the markets looking right now?
It is the last trading day, and we've had some pretty gloomy data, no less than the inflation data showing that it had risen again, a fresh 40-year high of 9.1%. We also had a pretty disappointing flash PMI data looking at Britain's private sector. It seems to have stagnated between the months of April and May, but we are going into the weekend in the green. The FTSE All Share is up at intraday by 1.27%. The FTSE 100 is up by 1.29%, and the FTSE 250, that's up by 1.25%. In the currencies market, the British pound is currently trading up against the US dollar by 0.33%, up 2 against the euro by 0.20%, and up on the Japanese yen at intraday by 0.47%, Laddie.
All right, fingers crossed. See how the markets close today. Thank you so much, Juliana.
Thank you.
All right, now let's take a look at what's happening in the U.S. See, stock futures gained today as Wall Street looked to grind out a rare positive week in what has been a rough first half of the year. Futures tied to the Dow Jones Industrial Average rose about 173 points to 0.67%, while the S&P 500 futures was up 0.79%. The NASDAQ 100 advanced about 0.96%. Well, let's have our correspondent, Mary Bird, with yesterday's close.
The U.S. stock market advanced slightly on Thursday as the Dow Jones was up by 0.63%, the S&P 500 up by 0.95%, and the heavy tech NASDAQ was up by 1.62%. It is clear that many investors are hopeful that the U.S. economy will be able to sustain despite the testimony by the chairman of the Federal Reserve Bank on Wednesday and Thursday. As Chairman Powell stated, that he does not see that he will be able to reduce interest rates anytime soon. It is going to be vital that interest rates increase to stabilize and to reduce inflation, which is his #1 goal with the economy. This could lead the U.S. economy into a slight recession, which he has not ruled out as a possibility. It is almost an impossible task that the Federal Reserve Bank has to stabilize the economy, but many investors are hopeful that even though this might be challenging, it will not tear down the U.S. marketplace.
All right, that was Mary Bird with yesterday's close. We see investors still weighing on that recession risk. Anyway, after the break, we'll get more stories on the African continent. Do stay with us. This is Business Incorporated. Welcome back now to our next conversation. South Africa's tourism data released recently shows a strong year-on-year uptick in tourist accommodation revenues, but figures are still well below the pre-COVID levels. Also follows the collapse of Comair, that's the BA franchise, and a rise in domestic airfares. Let's discuss this now with check out what the outlook for South Africa's tourism industry looks like. We have Matt Kindiger joining us right there, practice leader, Sub-Saharan Africa, Frontier View. Great to have you.
Hi, thanks for having me on the show today.
Yeah, so what does this latest data tell us about the health of the country's tourism industry that has been badly battered, during COVID?
Yeah, certainly. So South Africa's tourism industry has been really severely battered, as you say, by COVID, and now we're seeing the effects of the global rise in inflation. So South Africa's very large and prospering tourism industry before COVID effectively collapsed, especially international tourism over the last couple of years. This latest data is positive. We have seen an increase in total tourism revenue in April this year to about 28 billion rand. So that is for tourist accommodation specifically. And this is versus 18 billion rand a year ago. We've also seen occupancy rates rise from around about 25% to about 33%. So generally positive trends. But, as you said, data is far from where it was, or activity in the industry is far from where it was before COVID. So we have seen occupancy rates rise, but before COVID, they were at around 45 to 50%, and they're still about 15 percentage points lower. And we've also seen sort of secondary indicators such as the sale of beverages and food in hospitality settings and in tourist accommodation specifically remain about a third below what they were in 2019. So basically what we're seeing is, although the data is positive, it's heading in the right direction, South Africa has struggled to make up for the lost ground that it has endured over the last couple of years. And this is in very sharp contrast to what has been happening recently in Europe and North America, where tourism and domestic travel has increased significantly.
Right, and now that most COVID rules have been removed in South Africa, are you more optimistic about the recovery of the tourism industry?
So I would like to say yes, but unfortunately no is really the short answer. And this is mainly because, once we saw the Omicron wave pass and the travel bans be removed after Omicron, we were increasingly optimistic about the recovery for South Africa's tourism industry. But now the cost of living crisis in Europe and North America, because of surging inflation, is going to put a massive dent in the recovery of tourist arrivals in South Africa. And this is because the most lucrative tourists, the highest spending tourists, are from the UK, Germany, France, and the US. Hundreds of thousands of those tourists arrive in South Africa every month during the peak period, and we're going to see a significant slowdown in the pace of recovery there. So these tourists will prioritize domestic or regional tourism because they will be deprioritizing long-haul expensive international travel, including to South Africa. But that said, the removal of COVID restrictions in the longer term will have an important positive effect on sentiment, especially because most other top tourism destinations globally have more or less removed most of their COVID restrictions. And so South Africa has been a bit behind. So this will be a positive development over the longer term.
Right, we still need people moving around freely at this time. But how do these trends in tourism, affect the country's growth outlook?
So certainly the uptick in domestic tourism, at least, so an uptick in tourist accommodation receipts over the last year or so does reflect a gradual recovery in consumer spending, and consumer spending is a very important driver of economic activity in South Africa. We've had Q1 data released recently where we did see 2 or 3% growth in consumer spending. But unfortunately, because South Africa is still very dependent on high-spending international tourists, this has contributed to a recent downgrade of our growth view for consumer spending in South Africa over the next year and into 2023. And as a result, we are expecting the South African economy to actually post weaker growth than we were previously expecting. So South Africa's economy will be really driven by commodity exports, in our view, over the next 12 to 18 months because of very high global commodity prices. But weakness in the tourism industry is going to be a significant contributing factor that will pull down growth potential over the next 12 to 18 months, in our view.
All right, we'll keep tracking that industry to see how it grows. Thank you so much, Matt Kindiger, practice leader, Sub-Saharan Africa Front of View. It was great having you. Enjoy the weekend.
Thank you. You as well.
All right, now let's look at other stories on the African continent. We see domestic mobile voice traffic fell substantially in the quarter to March as more Kenyans caught use on increased excise duty charges from 15% to 20%. Data from the Communication Authority of Kenya shows that domestic mobile voice traffic, both on-net and off-net, fell between January 1st and March 31st by 7.7% and 1.4% respectively. In the quarter to March, mobile users spent 1.6 minutes on on-net calls and a minute on off-net calls on average. This was dropped compared to the previous quarter when they spent 1.7 minutes on net calls and 1 minute on off-net calls, partly buoyed by promotional rates by telcos. Calling rates have become punitive for many mobile phone users in Kenya since last year. The state imposed a higher tax through the Finance Act 2020. And Egypt left its benchmark interest rate unchanged, pausing to see if May's biggest hike in nearly half a decade would cool galloping inflation and restore foreign investor interest in the government's local debt. Central Bank maintained the deposit rate at 11.25% and the lending rate at 12.25%. The Monetary Policy Committee met yesterday and gave the decision a surprise because a spike in food and fuel prices has sent Egyptian inflation to its highest level in 3 years, with the devaluation of the pound in March adding to the pressures. The Arab world's most populous nation enacted a cumulative 300 basis points hike since March as it grapples with the economic fallout of Russia's invasion of Ukraine. And Nigeria is poised to lose its frontier market status because of persistent foreign exchange shortages in Africa's largest economy. According to a Bloomberg report, MSCI Inc. is considering downgrading the MSCI Nigeria indexes to standalone markets status from frontier markets. Loss of frontier market status could cast doubts on perhaps the only bright spot in Nigeria's flagging economy and stir more despair for investors. Africa's biggest crude producer has been rationing dollars because of lower oil income that accounts for about 90% of foreign exchange earnings. And that's it on Business Incorporated. Thank you so much for watching this week. I'm Ladi Williams. Bye for now.